Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, how are you?
Fantastic.
Hey, good. We have a great guest. In fact, it was a really good show. It was one I missed when I was on vacation. Now Mark is out, so we're tag teaming the show. Ramsey, do you want to do the intro?
Absolutely. So we're very lucky today to be rejoined by Byron Boston, who's the CEO of Dynex, a mortgage real estate investment trust. And the reason that we wanted to have him back on the show, and the reason it's so timely, is Byron is a student of economic history, and he has really an extraordinary view on sort of macroeconomics and geopolitical issues, which of course are really at the center of everything that we need to worry about as an economy. And it's not just big investors who need to focus on it. We as individual Americans, financial advisors, all need to have context. And so we're delighted to have Byron back. And I one of the things that I always say about Byron that I think is of many things that are interesting is that fundamentally, when he talks about how he views the world, he starts with four words: "I am a lender," and I think that's something that people not necessarily understand about what it means to be a mortgage REIT. But he's fundamentally a lender, and that lens, I think, brings a very interesting perspective on the way he looks at the world. So, with that, welcome back, Byron. We're delighted to have you. Tell us a little bit about yourself and your journey, and what brought you to Dynex, and what Dynex does, very quickly.
Sure. Ramsey, Paul, thank you so much for having me, and that's a fantastic introduction. I am very much so a student of history. I am an economics nerd, a very student of economics, and I found my way to that topic in college, and I'm very happy that I did. I am an economics major from Dartmouth College. And I found my way there senior year. It was not my original major. I had to switch my major my last year in school. And the reason that's important, and so many students are confused in terms of their majors, I switched that major because that's what I was interested in. I had taken a path down the wrong direction, mainly because of influence of others. And I'm so happy that at some point I said, you know what? I love economics. I want to switch my major. The head of the department helped me switch my major. And here I am, 63 years old. That had to be, at this point, it was 42 years ago. And 42 years ago when I made that decision. And I am so happy I did, because I really am an economics nerd. And so in this job at Dynex Capital, this is a core knowledge skill set that I lean upon and how we make our decisions. So I am a lender. I came out of Dartmouth College after studying economics. I came right to the Wall Street world, and I was trained in one of the better corporate lending programs at Chemical Bank. Spent 3 years as a lender. I went back to business school and studied finance accounting. Came back to Wall Street as a mortgage-backed securities trader. I was fortunate. It was before Larry Fink started BlackRock. One of the best. He ran one of the best mortgage-backed securities trading desks on Wall Street, and I was allowed to join that group. And so I believe I trained both at Chemical Bank and at First Boston by some of the best in lending and in investing and in trading. And the asset class in trading that I focused on was mortgage-backed securities. And so I started that journey as a trader in '86, 11 years on what I would call the sell side of Wall Street. And I flipped over to the buy side, where I was at Freddie Mac for 7 years, where I further honed my skill and knowledge of lending money against real estate. And in 2004, I started my first company. It was called Sunset Financial. It was a mortgage REIT. We took it public. I got a takeover bid in 2006. We sold the company, happily sold the company. The company was successful. And one of the most important things I can tell you about my career is that a chunk of the investors of my first company I started asked me to come to Dynex Capital and help them rebuild this organization. Dynex had hit some hard times, and it was in somewhat of a rebuilding mode. So this has been a turnaround. I'm very proud that I started a company, sold it, and I had enough happy investors to ask me to come and do it again with them. And so I'm still here. That was about 15 years ago. I'm in my 15th year at Dynex Capital. We are a real estate investment trust, a financial services company. And we generate dividend income long-term total returns by financing real estate assets. But most importantly, our purpose. We're here to make lives better. And the way we make lives better is by taking care of the individual savers who buy our stock or our preferred stock. We also make the lives better of our employees by creating a great working environment and giving them also an opportunity to own Dynex Capital stock and enjoy the dividend and cash income that we throw off from that stock. And then here's another category that most won't understand. We use leverage, or we borrow money to make money. In other words, we sell stock to our investors. We then borrow additional money to then take and lend that money to either directly to homeowners through securities or directly to homeowners. And we also lend against other asset classes such as apartment buildings, malls. We've pretty much lent against every asset class in Dynex Capital over the last 30 years or so. So our goal, again, make lives better, take care of the savers, take care of our employees. And the last category I forgot to tell you was we take care of our creditors. When we borrow money, we don't want to be a problem to our creditors. We want to be one of the best credits that they have on their books.
So I just want to jump in real quick there. So you've got a business that you are a lender. You're a leverage lender. And so tell us a little bit about why that makes you so sort of hyper-focused on what's going on in the macroeconomic environment.
So first off, just trying to think, every lender most people in this economy deals with, they're leveraged. So banks are leveraged. Banks leverage themselves through demand deposits, right? And so they can use other type of leverage, but their core liability happens to be demand deposits. We use shorter-term borrowings, which are not as, simple word I can use, not as easy as demand deposits. A little bit tougher when you're leveraging yourself through what we call the repurchase agreement market or short-term markets. As such, risk management is essential for running a real estate investment trust such as Dynex Capital. So if you ask me for just one line about Dynex, I'm going to say we bring to the table expert risk management, disciplined capital allocation. And those are the two skill sets that we bring to the table, and we'll present you with a very skilled and experienced management team. So we are leveraged. We must think about the global environment. We have a very disciplined approach. Start first with assessing the global macro environment, and then work your way down to ultimately either the bond or the loan that we put in our portfolio. And let me just add this one thing, Ramsey and Paul. I don't want to confuse anyone. If you lent money in 1975, more than likely you're making a direct loan to a borrower. In 2022, I have more options. I can either make a direct loan or I can buy a security that is backed by a pool of loans. And those are what we call securitized assets. So today, Dynex Capital balance sheet is majority, 99% securitized assets.
So talk about, and we were, Paul and you and I were talking about this before the call. Like, there's a lot going on in the world right now. So tell us about what's on your mind, and importantly, like why things might be different this time around in terms of market distress. Something that you have a great deal of patience for, because you expect it to happen every 4, 5, 6, 7 years, but it might be different this time. Tell us a little bit about that.
Well, if you look at the main question we asked at Dynex Capital is what is different this time? So there was a book written called This Time is Different, and you hear it quoted on TV and other shows. And I think that book is misleading. There is something different every single time. And the real question you need to ask is what is different this time? But be an avid student of history to understand global economic cycles, global market cycles. And at Dynex, we spend a fair amount of time trying to understand and assess global data, global economic data, social data, political data, and to assess and form an opinion first and foremost on the macroeconomic environment. We don't want to get so focused on that loan or that bond that we want to make and ignore the global environment, and we make a decision and then we get completely annihilated because there's a major macro change or such as at this point we've experienced 2 exogenous shocks in the economy. So in general, we believe at Dynex that the world changed as of January 1, 2020, that we have entered into just a completely new environment. What are the characteristics of the environment? First and foremost, right off the bat, we were hit with an exogenous shock as this decade started. What happened next? The global governments, both central banks and fiscal policy makers, responded enormously like none of us in our generation has ever seen to try to save the global economy given this situation that they intentionally shut down the global economy. None of us could have ever imagined we shut down the global economy. We were all sitting at home 2 years ago, not leaving our homes, right? So this enormous effort was made. Central banks took an unprecedented step, except maybe during World War II, of stepping into the global capital markets, buying ETFs, bonds. I don't know. It seems as if they bought a little bit of everything. And now, 2 years into that, we came into 2022 with the central banks intending to try to reverse that. And in addition, fiscal policy makers potentially trying to pull back on some of the fiscal policy that have been added to the economy. So when we started this year off at Dynex, we believe we were in a big moment in history. We've never been through this, where central banks at first built up their balance sheets that large, and now they're going to try to pull back the stimulus or the liquidity that had been pumped into the global system. And right in the middle, at the beginning of this process, we now experience another major exogenous shock. What do we mean exogenous shock? It's outside of the economic system, something that happens on the outside. Now we have to assess that and say, through what mechanisms will this impact the economy? And so we first had this huge drop in demand from the pandemic as we shut down the economy. This time we have another exogenous shock, and now we're coming through the mechanism of oil, energy, right? We're going to drive inflation with that issue. You could ultimately have a psychological impact because at some point the war could bring very negative psychology to the consumer environment. The largest one we'll all talk about is inflation. We had an inflation issue before the exogenous shock. Now it's been more exacerbated. And then when you think about it, we've got this supply issue, supply chains. If you think about cutting off Russian oil, in effect, we're saying, okay, we're going to cut off certain supply of our energy. But the demand is still there. So now we probably have a problem in terms of prices increasing as we try to allocate scarce resources. So we've enjoyed for 30, 40 years this wonderful world of globalization. It has helped keep inflation lower. It took a long time for many of us to recognize the full impact of moving production from an employee that asked for $15 an hour to an employee that asked for $1 an hour. That's in effect what took place, right? We moved to the low cost producing areas of China, Mexico, other places in Asia, and now these supply chains are being ripped apart, and we don't know what the impact will be. We do know that one of the mechanisms that it will transfer into the economy will be through inflation. Through energy prices, because that's one of the major areas that we're going to feel this supply chain disruption taking place in the short, medium, and long term.
Byron, just to step back to something you said earlier, what's different this time? Well, that implies we know the time that we're comparing this against. And, I was a history major in college. And I think back, they also, I think when we could have a whole show on this is I know you spent a lot of time in psychology, just the social change going on. I could say, well, what's different now than what we went through in 1968? I could say that here in the U.S. in certain points. Looking at what's taken place psychologically and politically, I don't know, is this back to the Weimar Republic? I don't know, in Germany, post-World War I, you've got national psyches, people trying to create myths that didn't ever, recreate history that never existed before. How do you factor the social change taking place at the same time?
Boy, The first point is you got to acknowledge the social issues. It's unbelievable how many economists I talk to, and they don't recognize the social issues. So let's go back to the inflation of 1970s that everyone wants to talk about. What took place in and by the side issue, if someone says that the inflation in 1970 was a Jimmy Carter issue, just ignore them. They don't have a clue what they're talking about. The inflation that developed ultimately in the 1970s was a result of multiple factors, I would say over the 20 years before 1980, between 1960 and 1980. Think about everything that took place, because it ultimately came through social issues, right? So you have a president shot and killed in our country. You know, we have this view of our country as a great history. We had a president killed, then we had his brother killed, we had Martin Luther King killed. We had enormous social issues that developed, enormous programs that were put in place to try to deal with this social unrest that was happening. You had generational tensions between the young baby boom generation and the older generation before them. And so this led to public policy issues that would ultimately play a role. It led to especially some of the programs that were trying to deal with poverty and other issues such as that. So these are social factors rippling through the economy in ways that you can't always predict. So let's think about today. What was amazing about 2020, we have this pandemic, and then what happens? Someone had a phone with a camera on it, and so they videotaped the police in Minnesota with his knee on the neck of George Floyd. So now we have this huge movement develop right in the middle of this unbelievable moment in history where we shut down the global economy. So when we think about what is taking place at Dynex, when we think about risk, we think definitively broader than just C plus I plus G plus net exports equals GDP. There are a lot of factors that ultimately come into play. Let me just point out a couple of them. Human conflict is at the top of our list at Dynex Capital. We're concerned about human conflict. Where does it come from? It comes from history. We're seeing this now, not only in the United States, we're seeing it in other places, right? You go to Turkey and you know, Erdogan doesn't want to admit that there was a Armenian genocide that took place. You come to the United States and you've got this debate over, you know, how are we going to look at our own history here in the United States? You'll probably go to Germany, you'll find some Germans who want to deny that there was a Holocaust. So right off the bat, the social issues around just what has happened in the past and how we're going to reconcile and deal with what has happened in the past today. Income and wealth inequality, in my opinion, is like high blood pressure in your body. They call it a silent killer. And so it's or as the professor from the University of Chicago wrote the book Fault Lines. It's a crack beneath the surface of the global economy. And it will manifest itself in ways that none of us can really imagine that it's happening. Whether it's electing an extreme person into office because a certain sector of the population feels left behind, or whether it's just an explosive situation that took place, remember the Arab Spring, or how about the French Revolution? We could go on and on in terms of how might wealth and income inequality manifests itself. You layer on top of that technology, and so now back to the human beings, right? Because that's what sociology and psychology happens to be. Technology has allowed us to really experience everyone else more than when I was a child. So I didn't grow up on the wealthiest side of the railroad tracks. But if you'd asked me if we were not wealthy, I would have been, no, I don't know what you're talking about. We're fine. But when I went to Dartmouth, and all of a sudden, I started to realize how other people lived. Then it was like, whoa, man, maybe life is a little different for us, right? But today, technology, TikTok, newspapers, Facebook, they keep everyone almost, coveting everyone else. And that's a psychological issue that comes into play. The wealthy don't live a life that no one else sees. The wealthy live a life where all the poor people can see exactly how they live and they can see what they're missing. So there are a lot of social factors that have come into play. The one that concerns me the most is human conflict. We're seeing that in terms of the Russian situation today. I had some more colorful language I've used in my office on this. I won't use that colorful language here. but we have had a larger amount of authoritarian type leaders rise to the global stage over the last, call it, 10 to 20 years. And it's concerning to us at Dynex. I hope that wasn't too long-winded. There's a lot of social factors that are happening.
No.
There's a ton.
No, well, and I think it's interesting. How do all these pieces add up to something different, right? Pandemic, we're stuck in, we're on Zoom. All of a sudden we realize, the technology has been sitting for 10 years. Actually, it's kind of useful, connects all of us. Ukraine is interesting because as I've started to kind of start talking to people, I know somebody, I know a startup in Ukraine. I talked to her when she had her 2 months ago. She had her bag of cash. We're on Zoom. She says, I have a bag of cash. I have a gun. My tank is filled with gas. Wait a second. I'm looking at you. I feel like I know you and I see you here. I think, Ukraine has such technology talent. We've had so many, especially in our business, I have worked with so many different technology vendors. Now these people are just a screen away. You feel like you know them. I talked to somebody was on Slack, slacking somebody and on video with a programmer in Ukraine doing their day job in a bomb shelter with Wi-Fi. Right now, to Byron, to your point, if you didn't have a camera and a screen and on every camera, I don't know, would Ukraine just be kind of a strange thing off to the side, and we don't know how to spell it? We barely, now we know how to say Kyiv, right? A lot more than that. A lot more.
Yeah, it would be off to the side. I'll tell you, I have a wonderful woman who reports to me, an employee at Dynex. She is from the Ukraine. She came to the U.S. in the 1990s. And she challenged me. She said, well, Byron, what's different between Bosnia in the 1990s? Her husband is from Bosnia. So he he unfortunately felt the brunt. He's of Muslim descent from Bosnia. And she said, what's the difference? The world didn't care about Bosnia and the world didn't care about Syria. Why is everyone responding to this? So she's from Ukraine. And I said, that's a good question. I thought about it pretty hard. And I said, the Ukrainians are doing something really, really powerful. They're using the media and technology to make sure that we all live this horrible journey with them. We're living this journey. I mean, we're seeing the president there. He's on the air. We can see it. We can see the story. We're living this with him. In the 1990s, when those events were taking place in the Balkans, we really didn't know. We didn't have live. In fact, some of the worst genocide events, we've only been told about it because no one who was there is really trying to admit it. If you talk to the Serbian people today, apparently my understanding is they'll deny that there was ever any type of genocide event that took place. But this is different. What's different this time, right? What's different this time? They're taking social media and they're ensuring that Byron, Paul, and Ramsey live with them or get close to it. We can't live with them because they're feeling the pain of this. What is taking place? We're seeing this president speak on video. We're seeing other people broadcasting up to the web. We're all living this experience day to day with them. Very different than the Balkan situation in the 1990s when we didn't really have internet at that time, didn't have cell phones, didn't have TikTok, didn't have Facebook, et cetera, et cetera. So we're living this event together. So it's hard not to feel something with it. I know there's a lot of debate about, why is this getting a lot more attention than even some of the Syrian. The technology used here is, to me, seems very different. And it's allowing me to live this with the people of Ukraine in some way.
So do you have any thoughts on how this might all play out? And I know that's a tough question because none of us really know, right? But
right.
There's so many directions it could go. So Putin could stop, right? He could keep going past Ukraine. Even if he stops in Ukraine, the outcome can be a lot of different things. There could be some sort of peace where he takes part of Ukraine and he gives some of it back to the existing government. There's all these various outcomes. Do you have any thoughts on what might be likely outcomes, or even if not that, what maybe the implications are for some of the various outcomes.
Yeah. Sorry. So as CEO of Dynex Capital, I am a coach, right? So the way I tell Smriti Papana, who's the president of our company and chief investment officer, I tell her all the time. I say, "You're the quarterback on the field. I'm on the sidelines. I'm the coach." I said, "So I can't come on the field and throw the pass." So I'm coaching my team through this event. So first and foremost, this is evolving. No one knows what's going to happen here. No different than the summer, July of 1914. No one really knew what was ultimately going to take place. But there are some things that I can lean on and say, okay, this is what's... The world has changed. Period. Get used to it. What we knew 10 years ago, and the travel and the globalization like it had gotten, and the great low prices we all enjoyed as the iPhones were made in China and brought back, one piece made in Mexico, one in China, one in someplace else. The world has changed. We are going to go through a decoupling process of some sort. What will it be? How dramatic will it be? How long will it last? We're not sure. Oil clearly has been a political commodity for ages. It continues to be a political commodity today. So we've got to come to grips with the fact at Dynex Capital, the world has changed. We don't need to sit around and beg and cry over spilled milk. The world has changed. So things can escalate or they could de-escalate. But we don't know which way that will take place. And what we do at Dynex is try to say, okay, let's think through these scenarios. What will we do in this situation? What will we do in this situation? What will we do in this situation? One of the complications here is that before Russia invaded Ukraine, at Dynex, we believe this was a big moment in history just based off of the governments trying to pull back the liquidity that they had pumped into, all this liquidity pumped into the global system to spare the world the pain of the pandemic. So that was huge in itself. So now you layer this exogenous shock on top of it, it really complicates the picture. Things have changed. Supply chains are going to change. If you recall in the 1970s, you may not have been born yet, Ramsey, but we all had to start, the speed limit on the highways were dropped from 70, 75 miles an hour to 55. It was a federal law. The speed, you couldn't drive over 55 miles an hour on an interstate highway. And so that was just a big deal. Everyone was like, oh my gosh, the speed limit is 55. And then I think gas stations were closing at night, and there was a lot of adjustments that had to be made during those oil embargoes. So it's been wonderful. We've had a great life. You know, everybody's been traveling, visiting other countries, and everything's been great. But things have changed at this point. Likewise, we all got used to this wonderful low inflationary world and prices continuing to come down. And if you look at history, in reality, inflation has always been tended to be higher than what we've experienced maybe over the last decade or so. So we're probably going to have to get used to, because if nothing else, these supply chains changing and breaking down and evolving to something new, we'll probably end up with more inflation than we had before. One concern, again, I have a concern on the human conflict, because I'm concerned that this wealth and income inequality is being exacerbated by all of these developments, from the pandemic to this current development. Clearly, the higher oil and gas prices are hammering the lower income parts of the world more than the higher income participants. So the future is very, very uncertain. It's not a new place for the world. The world has been, again, study 1914 to 1945, but you could also study other periods. You could study the 1960s. The world has, I know you wanted to say it's all nice and peaceful, everybody's happy, but that hasn't been the case throughout history. So things have changed. We are acting at Dynex as if things have changed. We're trying to draw up scenarios that include some very extreme scenarios.
So then how do you manage money differently? So you had the old regime, right, and you approach risk management one way, and now this is new regime. It's hyperinflation. Well, not hyper. It is inflationary. It is inflationary. There's a lot of new risks. Do you invest in different instruments? Do you how do you think about managing your interest rate exposure? Just big picture. What are some meaningful changes you think you'll make in the way you run your business?
Okay, so I'm glad you asked this question. I did bring this quote with me today. So 8 years ago, in 2014, here's a quote from my fourth quarter earnings call at the beginning of 2014. I said, we believe that economic uncertainty, regulatory uncertainty, and global market uncertainty have created a very complex environment for global growth to be able to accelerate to the level seen in prior post-war periods, recoveries. So we use the word complex. I got a ton of people who really challenged me for saying that the global risk environment was complex. That was 2014. So why is that relevant? I joined Dynex in 2008. When we first started to invest, we invested safely. Then we took on more risk starting about 2009. We went what we call down in credit. We bought BBB assets, single A rated assets, some non-rated assets. We took a ton of risk in terms of credit. About this period in 2014, because we were concerned about the rising level of global risk complexity, we started to go what we call up in credit and up in liquidity. We sold our lower credit rated assets. We then started to sell our less liquid assets. And we moved what we call up in credit and up in liquidity. By 2018, we were pretty much 95% ownership of the assets on our balance sheets that we own were all the most liquid real estate bonds that we could find, which are 30-year residential Freddie Mac, Fannie Mae securities. Furthermore, we increased the amount of cash in what we call unencumbered securities on our balance sheet, or what we call our liquidity. Versus 2013, when Bernanke said taper, we're probably carrying 6, 7, 8 times as much cash and unencumbered assets on our balance sheet. So we're very, very liquid, and we have a very, very flexible mindset because we believe the world is complex, and we believe we're going to be surprised. The phrase we use is surprises are highly probable. Clearly, over the last 8 years, the surprises have continued to come, and we've stuck with our posture of being up in credit and up in liquidity. This gives us the ability, in my opinion, we make the right decisions. We have the ability to make money in any environment. Now, you got to be able to assess the environment. Right now, you can't assess the environment. It's uncertain.
So higher quality credits, higher liquidity, and that served you well through the pandemic. Right?
Yes, very well through the pandemic. We were ready for that. We were very
not right. Like if you look at some mortgage REITs did better than others.
Yes,
through the pandemic,
substantially better.
Put it that way, and then here you are in this next crisis, and it sounds like it's a strategy that works. It's continuing to work well. The takeaway for this audience, is just sort of think about things. Is like, all right, well, how do I think about my own portfolio or my clients' portfolios? If one is to sort of follow your lead, it is a flight to higher quality. A flight to higher quality and having more liquidity as opposed to sort of dialing up on risk. But the interesting thing is everybody's dialing up on risk these days.
They are.
Right? We're in a low interest rate environment, so a lot of people are going the other way.
Yeah,
right?
they are.
So that's kind of an interesting dichotomy there.
Can I give you a thought on that?
Sure.
Because I'm always thinking about the individual investor. I'd say 50% of our investors are what we call retail investors. And I have a great concern for my generation, the baby boom generation. I've just talked to too many friends who all believe in buying the dip. They all use phrases like, well, it always comes back. Don't sell, buy into it. It always comes back. Buy the dip mentality. I would urge, whether if you're an investment advisor listening to this or if you're an individual listening to this, I would not simply fall back on the buy the dip mentality. I would really do some analysis and understand why you are continuing to, if you've got you're just fully invested, for example, all of your risk is in stocks. I would try to diversify in some way, shape, form, or fashion your holdings. I would ask myself what would happen if the stock market corrected and it didn't come back for 7 years. So I'm using the 7-year benchmark because I think if you bought the S&P 500 in 2000, Jan 2000, I don't think you got back to even till 2007, and then you got clobbered again with the great financial crash, and then you had to wait another probably 7 or 8 years after that to get back to that level. If you would have bought the S&P 500, I think in 1929, you didn't get back to even until 1955.
Yeah.
And so finally, we ran a chart at Dynex that layered on the growth of the Fed's balance sheet and the S&P 500. And if you just, a visual looks like a one-to-one relationship, right? So there's been a ton of liquidity pumped into the global system by the central banks. That has inflated I don't want to be too, an enormous amount of elevation in global asset prices. Stocks, antique cars, art, houses. At least in housing, I think is a little bit unique. I have an opinion on that I'll give you. But crypto, there's an enormous amount of liquidity that has supported global asset prices. I personally, this is a Byron opinion, I am concerned about a global asset price correction. I don't believe, if let's say you didn't have the Russia situation, if the central banks would have tried to reduce their balance sheets, and if they try to do it now, eventually, I do not believe they can do it with a soft landing. I don't believe that they can do it with a soft landing. I just don't believe they can do it. So I am concerned about the baby boom generation. Why? Because I'm 63. So let's say I take a hit in 2000, it doesn't come back to 7 years. Okay, I'm 70 now. And then let's say I take another hit like the great financial crash when I'm 70, and maybe I'm dead by the time or before it comes back. You see what I'm saying? I mean, I'm just being real here about it. You've got to think, if you don't earn money anymore, you've retired. A lot of baby boomers have retired early, right? The great resignation. You must make sure you think about, do you have enough assets to go as long as you want to live? Everyone says, I want to live till I'm 90, 95. Really? Well, then maybe you should work till you're 70. So check your income, make sure you've got enough coming in, and understand that this is a unique moment in history. Don't just buy the dip because you bought the dip in 1990s and everything worked out okay.
Wow. Ramsey, this was great. We're at the end of the hour. It went fast.
Sure did.
Yeah.
So, Byron, thanks for coming back. A lot of takeaways from that, but perhaps the biggest one for me this time around was, that there's not probably a scope for soft landing, and most importantly, you didn't see a soft landing before Russia invaded Ukraine.
No, I really don't.
So whatever the delta was on, there not being a soft landing, it's even higher. So a hard landing, the delta for hard landing is even higher.
Yeah.
So that's a very, very sort of interesting view, and it's consistent with your focus on liquidity and higher quality.
And we're still able to generate a solid above-average dividend yield. It's not like we've said our shareholders are well out a great above-average dividend yield. Where our guys are still making solid cash income from both our preferred stock and our common stock.
Yeah. Well, Byron, thank you again. This was. I've got a lot more questions. We'll save it for next time. If people want to get more of what you're telling us, how do they do this? What's the best way to follow? What you're writing, saying, doing.
We do have our quarterly calls are very detailed, and we do have a macro view. We start with a macro view to ultimately get to the investments. So every quarter we do have a call. Sometimes I post on a LinkedIn, but I try to be very careful about some of the social media. We do at Dynex. We do post certain points. We thought about some of the economic thoughts that we have, but it's like when I said complex in 2014. I had so many people who didn't understand what I was really saying, or why were we going up in credit or up in liquidity. And so sometimes I'm like, fine. I've got shareholders who listen to us, and we're all in the same boat together, and we're happy, and I want to take care of my shareholders. It's very, very important. So please, there is a quarterly call that's there. I urge people with annuities to look to diversify with something like a Dynex Capital stock or a preferred stock. And we're in the same boat as all of our shareholders. We're dedicated to making their lives better.
Okay. Hey, listen, great. Ramsey, thanks. Byron, thank you. And thanks to all our listeners. Join us again next week for another episode of That Annuity Show.
Thank you for having me.
All right. Appreciate it, Byron.